Hi guys. Today we will analyze Occidental Petroleum stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a good performer in the overall market. The long-term trend is neutral, while the short-term trend is negative. It is advised to wait a little bit longer to see how this turns out. Strong support level is around $55. Next strong support levels are around $38 and $24. Strong resistance level is around $66. Next strong resistance level is around $71. In the last month the stock has been trading between $56 and $66 range. It is currently trading near the lows of this range. The stock has an average volume of 24.5 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 23% per year, for last 5 years. We see that the average profit margin of the stock has been around -9% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 86% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Occidental Petroleum Company: bad, average, and good. First scenario. Occidental Petroleum will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 4%. Future profit margin would be a low, 6%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $33. Second scenario. Occidental Petroleum will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 6%. Future profit margin would be average, 7%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $41. Third scenario. Occidental Petroleum will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 8%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $51. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 10.2. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Occidental Petroleum, analysts forecast growth rate around 8% per year in next 5 years, and future P/E around 6. Again, I will use 3 different scenarios for Occidental Petroleum Company: bad, average, and good. First scenario. Occidental Petroleum will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 4%. Future P/E would be a low, 5. In this case, the fair value of the stock today would be $31. Second scenario. Occidental Petroleum will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 6%. Future PE would be average, 5.5. In this case, the fair value of the stock today would be $40. Third scenario. Occidental Petroleum will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 6. In this case, the fair value of the stock today would be $52. As you can see, today the stock is overvalued, $59, even if we expect the company's high performance in future. While the company has a great profitability rating, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 8% yearly. Based on that, the stock looks a bit overpriced at the moment. I may consider buying the stock when the stock drops below $50. Keep in mind that due to the volatility of oil markets at this time, the stock has a very high uncertainty rating. Company strengths. Occidental Petroleum Corporation is an American company engaged in the acquisition, exploration, and development of oil and gas properties in the U.S., the Middle East, Africa, and Latin America. It's one of the largest U.S. oil and gas companies, based on equity market capitalization. Warren Buffett is close to making Occidental Petroleum a 20% position in his Berkshire Hathaway company. Several stories have predicted that he will eventually buy the whole company. The arguments in favor include the strong cash flow, suitable size, ideal interface with Berkshire Hathaway Energy, and excellent CEO who shares Buffett's reasonable views on carbon energy and renewables. Occidental is aggressively paying down debt in the near term, and the company could be a more significant exporter in the long term. The company has a dominant position in the Permian Basin, which is the cheapest source of production in the U.S., and is expected to be a major growth engine in the next few years. The low-carbon ventures segment is synergistic with Occidental's chemical business, and Occidental's EOR portfolio holdings and expertise give it a natural advantage in carbon capture. The company's return on assets of 15%, return on equity of 39% and profit margin of 32% are amongst the best returns in the industry. Risks. Analysts see the supply-demand imbalance in the energy sector as a long-term structural problem, and it will not go away in the short term. Occidental's performance is tied closely to oil prices, which can cause dramatic swings in stock prices, earnings and cash flow. The company does not have any meaningful production hedges in place. Occidental's investors are also exposed to trends in global economic growth and interest rates. The liquefied natural gas and offshore assets, acquired from Anadarko, are not a strong strategic fit for Occidental, and it will take more time to generate sustained sales and earnings growth from these assets. Spills are mainly a concern for firms operating offshore. Offshore activity is not the main focus for Occidental, but it does have operations in the Gulf of Mexico that it inherited from Anadarko. The company has a high debt level. The debt is mostly due to the Anadarko acquisition. Other risks include lower than expected cost synergies, weak Permian production or pricing, poor returns on non-core asset sales, and a credit rating downgrade. Due to the volatility of oil markets at this time, the stock has a very high uncertainty rating. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 8 to 10% on average per year. The earnings per share is expected to grow by 6 to 8% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.